And let's bring in Mr. Zach Mans. Zach, good morning. How are you today?
Good morning, Blake. This is actually the second time that I've been on with you that Dale's been out. So
You
looking
know
for,
what? He likes to duck out every once in a while, and we gotta give him a break since he wanted to drive off to the sunny California coast and get out of the heat from Central California. So hey, it's good to see you again.
good to see you. It's so there's a little bit of confusion because Juneteenth also creeps up on me that I don't remember that it's a market holiday until the week of. And back
Right.
in March when Dale asked me to be on again, he said he said Friday the 19th. So I messaged him yesterday. I said, "Did you mean Friday the 20th or did you mean Thursday the 19th when the market's actually closed?" Said I'm fine either way. Just let me know. So happy to be here.
Well, glad you're here. And this is a great day to get caught up anyway, just because obviously there's some shit going on. We have some little rocky road ahead with all the geopolitical heebie-jeeba going on, and you even have futures open this morning, drifting lower. You got European indices that are looking a little uh little cautious here with the DAX back below the breakout point, approaching a 24% retracement. I'm going to turn the charts over to you here in a second, but I want to ask you this real quick. What do you make of the current state of where we're at, and what's your view of, generally speaking, of the market overall?
So I mean, I think we've what we've talked about the last several times I've been on with you guys is the overall risk skew that in terms of larger magnitude moves off of 2009 lows and even off of the COVID lows, we're getting up into some pretty thin air, but things still keep holding consolidations and then getting another extension higher. So until some like more serious support breaks, we have to look for where that consolidation, if it's going to hold, is likely to hold. And then what are the better things to play for that next possible extension, but at the same time being mindful of the overall risk skew and saying, okay, if things are going to start to break down, where are they going to rear their head first? And so trying to be first in those areas.
So Zach, let me ask you this question, because you look at equities, and let's back it up a little bit to Liberation Day. Liberation Day obviously scared the shit out of everybody. Only the retail market really were. I mean, I was. It was so funny. I was telling the story the other day. I think I was on the Face Show. It was maybe a couple weeks ago. I was like literally in Costco, and I was like the guy that's ringing my $500 Costco order up. He's talking to the lady behind me, and she's like, "Oh, Jim, oh my God, I miss buying Nvidia." This is a mom with like two kids in the cart, and it was like on a Tuesday, I don't know, around noon or so, and I'm sitting here, I'm listening to this lady talk to the guy checking me out at Costco, beeping all my stuff. And he's like, "Yeah, I bought Nvidia and I bought this and bought that." It's so funny because retail, and that's definition of retail right there. And because I had a mom with kids behind me talking about buying, chip stocks as well. They had the balls to get in here, but a lot of hedge fund managers, a lot of institutional traders, they have not, and they've been watching this squeeze higher, and very cautious about putting money to work with obviously the risks that you have with the Trump administration and tariffs and whatnot. So where does that leave the market at this point? I mean, in my view, it leaves us open for a potential squeeze higher to all-time highs, especially if we see some resolution from a geopolitical point of view. What are your thoughts about that as a whole?
I mean, I think, that kind of anecdotal retail, I mean, it's the smaller money. It's that odd lot theory. And it's certainly that it's prevalent, and I think some of those people did buy, but I don't know with how much ammunition they were really able to buy that April dip. I mean, we were looking for a pretty significant bounce from there, and obviously it's extended past that to the point where if you want to turn over, I'll show you like,
Yeah, yeah, sure. Yeah, let me let you grab the charts here. Go ahead.
all right. Maybe I can share.
You
There we go.
should.
Yeah,
Let me see. I'll let you know when I see your charts.
that's the win.
Yeah, I see them. They're coming up anyway. Yep, I got
Okay.
it.
So I'm just gonna switch it over to the RSP, the equal weight S&P, because that's one thing that I like to track that kind of smooths out some of the noise. But we were looking for a pretty significant bounce that was very possibly just a B wave and a correction. We'll talk about in a minute how we've gotten high enough that more things are starting to flip in favor of the more bullish alternative that allows us to hold a consolidation and head to a higher high. Um, but I think the way that we move, the air is pretty thin. We're back up against resistance. Things are really starting to like slow down and show some divergence and some lack of any kind of oomph to get further extension. But RSP also particularly hasn't made an actual higher high over what counts best as the third inside that C wave. So it could get a final exhaustion gasp to get closer to a near full retrace of the move down from December that the S&P and the Nasdaq have. But what I've been focusing a lot on in my posts, both on X and to our subscribers, is that there's a lot of charts where they can kind of go both ways, where this move can still be a corrective B wave and the start of something bigger. But if it is going to start a bigger move down, that should fill out as a 1-2 move first and give people a little bit more of a gentleman's entry, similar to what we had back here in at the very beginning of April.
So
We
you think the market's going to be a little bit more forgiving and give us that gentleman's entry?
It might not be as clear and straightforward at the moment, but it'll certainly be at least similar to what we had back on like the Nasdaq. Oops, need to go to the back adjusted. We did get one back here on, I think this was a Fed day on April 2nd, where at the time, the last time I was on with you guys was March 25th, and the more normal pattern for this B wave back here would have been to hold a corrective retrace and then filled out as a wider flat. Instead, that dropped to a nominal lower low, and then it got a corrective bounce right into the Fed, and then a pretty swift reversal. So if you saw that as another lower high and that reversal is something serious, then even though the ideal would have been to hold here and fill out as a wider flat, once this low broke, then you could ride that train all the way down into the April lows and then look for the extremes to set up for a bounce from there. So it's not always as crystal clear right at the moment, which is why we kind of back out and say, look, at the larger degree, we're looking for a move down into the 160 region on RSP, whether that's 5 waves down as wave 1 or an ABC for a B wave. Unless it's a really clean ABC and you get a nice reversal off of here and then can use that as support, it's really not worthwhile putting a lot of faith in that move higher to get to the 190s, 200s as another extension to new all-time highs. But you could certainly play a move like this with a very selective list of some stocks where that looks more probable in order to get some successful follow through there.
Okay, well, let's all hope. Let's all hope that's what happens. But let me ask you this, Zach. Because obviously you're counting waves, and I'm a big Elliotician fan. It's something that I don't practice. I rely on our staff to give me their projections from an Elliott wave point of view. But at what point? Because I can, and this is the same thing with Fibonacci's, which has been a staple of my trading since I used to do it with protractors on charts that I printed out
That's
in
awesome.
the
Like Hill and
90s.
Meisler.
Yes, Helene and I, we've followed along the same book over the years. So Helene and I know each other quite well. I email with her every day. So, but the reason why I ask you this is because I can make an alternative count for pretty much anything, just as I can draw a fib for pretty much every move. So, at what
Right.
point do you shift gears from an Elliott wave point of view where you go, "Oh shit, that wasn't that wasn't a third wave. Now we're in a longer, a fifth wave. And at what point do you shift gears? Because like I said, I can change up my trading plan
Right.
at any time. So,
I think the fractal nature of Elliott wave makes it possible that there are alternative ways to count.
okay.
And so I think part of it is you're looking at the larger context and saying, does what I'm seeing at a smaller degree fit within a larger context? So, you have an ABC consolidation here that could have been a fourth wave. That fourth wave would have been in a larger ending diagonal for this parentheses wave 5 in the SPX. So if you're getting a fifth wave, it's going to be an ABC move. So this is clearly, when you look at the subwaves for this structure off of April, you have a very clear ABC start. Then you have a
Yeah.
consolidation as a B wave, and then we can count 5 waves up into resistance as a C. So that works as the B wave, as a corrective B wave bounce that's so far holding a nominally lower high, but it works just as well as the A wave in that fifth. So then you're saying, okay, which one, those can both be true. And then you look for the points of overlap and you say, okay, if this is the B wave topping, then I should get a 5 wave move down for the wave 1 of that C wave. And I know based on the Fibonacci pinball and the guidelines for Elliott wave that, if my measured move for that C wave takes me down to 4765 or maybe the 1236 down at 4500, then my wave 1 of that should fall somewhere in this 5530 to 5370 region. So I'm looking for that as my zone for a possible 5 wave move down as wave 1. And then you can even break that down even further and say, okay, I know that what the proportions of a wave 1 to that region should look like. That should be a 5 wave move, ideally as an impulse, which would have a wave 1 that maybe comes down to the moving averages and then backtracks and gets a lower high as a wave 2, and then fills out a 3, 4, and a wave 5. So I can
Gotcha.
say
Yeah.
that's what I
Oh,
want to see. But if I'm not seeing that, if I'm seeing something that looks a lot more like a corrective consolidation, there are ways that a more bearish C wave could start as a corrective consolidation, but those aren't always the most reliable. So if I'm seeing something that starts to fill out, even though it's coming down into that region that you can count as wave 1 of the start of something more bearish, if that looks like a clear corrective consolidation, then you play for the potential at least of a decent bounce and a possible move higher with managing your risk accordingly.
okay. That's a great explanation. Hey, do us a favor. Let's take a look at what you're seeing with precious metals because we just had a big conversation with my staff here about gold, silver, and that really having a hard time having a macro thesis to be on the short side of metals. How do you see gold right now?
So before we jump into the individual metals, I did want to take a look at the ratio chart that
Okay.
the gold and silver ratio chart that I've been looking
Yep.
at, which we have this sharp move down after a pretty significant high that can count as 5 waves up. And for most commodities, not, usually excluding precious metals, I think they tend to function more like oscillator charts where you're not really getting long-term trending moves. You're getting more corrective price structure back and forth between extremes. But even though that's the case, I think this ratio chart happens to count as a 5 wave move up into this extreme. I'm counting with the GLD versus the SLV because I use the continuous futures contracts that I also started using the back adjusted because of where rates are. You get those big price jumps when the futures contracts roll. So that was wreaking havoc on my ratio chart. So I switched over to just using GLD versus SLV. It gives the same view. It just doesn't adjust like that. So we have a corrective looking bounce to a 764 retrace in the ratio that we can count as a B wave, but that has to count as a WXY. So if we're going to look for a more normal C wave, this drop down in favor of silver in the short term could just be a fourth wave, and we could get another push up that favors gold a little bit more than silver, but I would like to see the ratio head down closer to the 60 region versus the 90 region where we are in terms of that ratio. So this chart does still suggest that there's potential for not necessarily for gold and silver. The ratio doesn't imply that gold and silver have to go in different directions. Just the relative strength of silver should outperform gold over the next 12 to 18 months or so. But we can have a little short-term weakness in some silver relative to gold. But the gold chart itself, still long-term pretty bullish.
Yeah.
Short term, I would like to see some more consolidation here as long as we're staying under this recent 3470s high. I think that can be a B wave top in the very short term, and we can be starting to fill out a consolidation. If that consolidation gets closer to the 2900, then I think that increases the probability that that's all of this fourth wave, as opposed to being just an A wave and needing a B and a C of a wider flat. But
All
then,
right. Well,
but then
and,
I'm
and
looking for a move up to 4,000 plus for gold.
okay, all right. So that's why I wanted to confirm there. Well, Zach, I just as we're wrapping things up, I wanted to ask you what do you have right now as a standout? Like you came today and said, I really want to show you guys this.
Um, Probably uranium. We were looking for a bottom in this wave two back in March, and it leaked lower to a little bit deeper than ideal retrace, but it held support. UEC and CCJ held much, much higher relative fib levels for this wave two, and we just got this massive, massive reversal. It's
That's a big,
hard.
big,
It's
yeah.
hard to rely on any consolidation inside here for the URA for the index as the minor degree wave two. And CCJ especially looks more like five waves up. A lot of the individual names also easily count as five waves up trying to top. But there are some things that are more clearly hinting at breakouts where we might have to back up and count this as all of the wave two, and this is another smaller degree wave two, and then nested structure that's trying to continue to break out. Very, very long-term bullish uranium. Think this is just the very beginning of a massive primary wave three. And so maybe we're further along in that intermediate parentheses third inside that primary wave three, which can be targeting up to the 80s in URA.
Damn.
Some consolidation in the short term would still be pretty welcome. I look at the UEC chart and it's right on the cusp of trying to break out again past resistance that would count best as that larger wave one in the start of the same parentheses wave C. So this can be just an alt of this B wave and can still try and fill out a little bit of a wider flat into the normal fib support region. But if it creeps back over the 720, 750 region, then we really have to start giving it some headroom as the breakout in the third of that third, or at least with UEC, maybe it can be a larger version of this wave one. But some of the smaller names like Energy Fuels definitely look like a nested structure. Although the interesting difference about this one that we talk about a lot in our metals mining and agriculture service is that this bottomed in the primary wave two back in April, not the intermediate wave two and the start of primary wave three. So while it can be a more nested structure off of that low and ready for a breakout in the third of a third, that third of a third is inside its larger intermediate degree wave one, where URA, UEC, CCJ, and a lot of others have already done this in the wave two and are starting that third. So there is some room for some differentiation between those names, but incredibly bullish on uranium. And I think we're seeing some good fundamentals for that with the current administration backing up on some of the incentives for wind and solar. Not that those aren't good, valuable parts of a clean energy program, but giving some love to uranium, which there's never in history have we discovered a higher density energy source and then stopped using it in favor of things that weren't as high density.
That's interesting argument there, and yeah, it's a hell of a move, man. Well, Zach, I want to thank you for being here on Juneteenth on your holiday. Hopefully, you get to do a little bit of enjoying of your holiday. What part of the United States are you in?
I'm in Maryland, the opposite side of the pond from you guys, I think, or not pond,
Yeah,
but
I'm in Scottsdale, and you don't want to be here right now. So, yeah. So, all right. Zach.
the other bright spot that I continue to talk
Okay.
about, I talked about this with Dale back in March. We really like Tesla a lot, and think regardless of what equities might do, Tesla, as long as it's going to hold, ideally the 270 region, and certainly the April lows, is poised for some pretty big things.
All right. Well, maybe now that he's out of Doge, we can see some of that. So, awesome. Zach, tell everybody a little bit about how they can follow you and your work.
You can follow me on X at Zach ZAC Mannes MANNES. Can sign up for a free trial for stock waves in the metals mining and agriculture service as part of elliottwavetrader.net. Blake can share the links, or I can put it in the chat afterwards or on one of the X posts of the face interview. Also, we started working with Yahoo Finance's community and are sharing some stuff in there, similar to what we post on X for the public at large. Try to be a little bit silly and entertaining at the same time of sharing some actual valuable content.
All right. Well, thanks, Zach, for joining us today. Appreciate you, like I said, appreciate you being here on a holiday. I'm glad I had the opportunity to sit down with you again, without Dale here. So, all right, guys, that's it for us today. Happy Juneteenth, Zach. Thank you so much, and you
And
guys.
Blake, you need to give me a follow also, so I can chat with you on DM.
Okay, sure thing. We'll do. We'll
All right.
do. All right, buddy. Have a great one. And
Take
hey,
care. Have a great
everybody,
day, everybody.
yeah, have a good holiday. I'll catch you all tomorrow on the Face Show. Remember, there's a lot of shit going on right now, and it's not a time to be, you want to be complacent. So if you are out and about in the markets, make sure you're paying very close attention to the headlines. They are moving the markets. All right, guys, good luck. Have a safe one, and I'll catch you tomorrow. Ciao.
Bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.